We can't solely rely on the 1% rule as our only analysis metric. Does the property need $100,000 in renovations, or is it turnkey? That's a really important factor that the 1% rule will not by itself tell us. It could just be a giant pain in the ass, and that's something that you're going to want to factor in as a real estate investor, because if you can get a certain cash flow for a property that has no pain in the ass factor, but you could get, a 10% increase in cash flow by getting a giant pain in the ass, I know which side of that equation I'd pick all day. This is episode 3 of the 1% rule. If you guys missed the previous videos, we dove deep into all kinds of subject matter. In fact, we talked about high level what the 1% rule is all about. We showed you some basic examples. Then we dove into some more specific examples and really broke down the exact numbers. All this in video 1 and video 2. This is the real life example from video 2. If you guys aren't familiar with the 1% rule, I highly recommend you check out the first 2 videos, but in today's video we're going to focus on the pitfalls and downsides of the 1% rule. Yeah, there are downsides and pitfalls when it comes to the 1% rule. We can't solely use that as our only analysis tool. It's just a rule of thumb. It's just the beginner steps in the analysis process when it comes to real estate investing. Alright, now let's talk about some of the downsides or pitfalls that come with the 1% rule and why we can't solely rely on the 1% rule as our only analysis metric. So when we're looking at the 1% rule, it's really important that we understand that that's not going to indicate the condition of the property. So does the property need $100,000 in renovations, or is it turnkey? That's a really important factor that the 1% rule will not by itself tell us. So we need to really take into consideration a lot of these other factors like the condition of the property. The next one is the operating costs. So again, the 1% rule, that's looking at the gross rents, not the net income. Big distinction there. So operating costs, for example, ways that an investor may be able to increase their gross rents while not increasing their net income is things that kind of one-to-one increase gross rents. So if I pay $100 to include internet into my rent, and I increase the rent by $100, that doesn't actually impact my net cash flow. So again, understanding our operating costs, extremely important. This also can come into play, say, with condos. Some condos can have prohibitively high maintenance fees, prohibitively high condo fees, and that won't necessarily be represented if we're just looking at the 1% rule. Then we also have to look at your cost of borrowing. So in the previous examples we did in the earlier video series, we assumed kind of 3.5%, 4% interest rates, whereas you may end up having to pay higher interest rates, and depending on the project, you may have to pay higher interest rates because of the building. So if you're paying 3 or 4%, the 1% rule, great rule of thumb. But if the cost of borrowing for you or in your market is 10%, 15%, or 20% interest rate, well, that's not going to work out really well if we're trying to still leverage our investment and we have to pay that mortgage payment. So really important that you understand your cost of borrowing, your operating costs, the condition of property, as well as the market fundamentals. What's going on in your market? Are you in an extremely bullish market, or are you in an extremely bearish market? You may be able to find a property that meets the 1% rule, but if properties are losing value by 10% month over month, you may not want to actually buy that property in this exact moment. That's another factor you should really take into consideration when looking at the 1% rule. As well, we need to look at vacancy rates. So I mentioned in video 2 that here in London, Ontario, we're looking at like a 2% vacancy rate. But if in your market you're looking at a 10%, 20% or higher vacancy rate, even though a property may theoretically rent out for a great rent amount, if you can't get tenants to move into it and pay you that amount, well, this was all an exercise in futility, wasn't it? Then we can also look at the affordability of rent. So that's a big one for me as an investor here in London, Ontario. When looking at affordability of rent, for example, say a 1-bedroom apartment costs $1,000 a month. Well, minimum wage here is $15 a month, or $15 an hour, I should say. So if we take that $15 an hour and we look at the average hours that an average employee works over a course of a year, that's about 2,000 hours. 2,000 hours times $15 equals $30,000. Now, when we look at the purchasing power and how, the average Canadian spends their money, we're often looking at, say, 30 to 40% of income going towards shelter. So if we have $30,000 a year in income, that person is likely to spend, say, $800 to $1,000 a month on rent. So how likely is it that the average person can afford our units, afford our property? So again, London, Ontario, if you're renting out a 1-bedroom apartment and you're able to rent it out for $1,000 a month, well, seeing how the average minimum wage earner in this city could afford that rent, that shows a very strong affordability. Then finally, we also need to be looking at fake rents. This is a big issue if you're buying property and basing all your calculations off of a rent that the seller is telling you. Especially true when they talk about theoretical rents or best case rents or highest best use rents. We need to be looking at where the rents are today and what a realistic plan to get those rents up would cost us. It's not just enough to know that in theory a 2 or 3 bedroom apartment in Toronto might rent for $2,000, $2,500 or $3,000 a month. But can you actually get that rent in the type of property you're looking at? Maybe that's downtown Toronto and your property is way out in Milton, Mississauga, Malton area. Well, the rents in that part of Toronto are way different than downtown Toronto rents. So it's extremely important that we understand that fake rents can be a thing. This is also true if, say, a seller has a family member currently living in that property and that family member's paying above market rents. In that case, we need to really adjust our rent amount to what realistic market rents are for that property or unit rather than just relying on what the seller's doing today. Then finally, we also need to look at the management hassle. And so when I'm talking about management hassle, just because a property does great cash flow, even if you factor in a property manager, it could just be a giant pain in the ass. And that's something that you're going to want to factor in as a real estate investor, because if you can get a certain cash flow for a property that has no pain in the ass factor, but you could get, a 10% increase in cash flow by getting a giant pain in the ass, I know which side of that equation I'd pick all day. I'd pick the 0 pain in the ass and take a 10% reduction in my net cash flow. And then finally, last thing I really want to talk to you guys about is also just overlooking the value add plays or the opportunities to create forced appreciation. So again, the 1% rule usually is going to be looking at the property in its current use, or maybe if we made some mild tweaks. But what if there's a basement apartment that you could add? What if it makes sense to build an addition on that property and we can add a whole other unit? Maybe there's a garage that you can rent out and increase the gross rents on. Maybe you can convert that garage into an apartment or a granny suite. Again, there's a lot of different options here. In video 2, we talked about converting, say, a dining room into a second bedroom and how that's going to directly impact our forced appreciation and valuation of the property, because it's going to have a big impact on our gross rent. So this is kind of the idea of the 1% rule in a nutshell and why we can't just rely on this rule of thumb. Again, reminder, this is a rule of thumb. This is for initial analysis only. This isn't where our due diligence process stops. This is where it really just begins when it comes to real estate investing. Okay, now that you understand some of the pitfalls and downsides of the 1% rule, what should you do if you find a property that initially looks like it could meet or exceed the 1% rule? Well, like I mentioned earlier, this isn't the end of our due diligence process. It's really just the beginning. So the next thing we need to do is dive deeper into the numbers like we did in video 2. You need to get real expenses and start applying those against the current incomes or your expected incomes once you execute your investment strategy. Also, if you're struggling to get the real numbers from an existing seller, another way that we can pivot is go look at similar properties and what their operating expenses are. It's really important that we understand that. In addition, as part of our due diligence process, you need to start reaching out to your lenders and figuring out exactly what your cost of borrowing is going to be so that we can update and make your analysis more accurate for your personal situation. Really, we just need to figure out all these different factors. You need to go start talking to your insurance company, get multiple quotes there. Again, we just need to figure out all our costs from all our service providers so we can create the most accurate analysis possible. As well, now it's time to go and inspect the property. You need to walk through it. You need to inspect it for any material defects, the condition of the property. Is there any deferred maintenance? What's the furnace like? What's the windows like? What's the roof like? What's the electrical and plumbing like? All these factors are extremely important for us as real estate investors to make sure that this is the right property for our investment strategy and our business model. Speaking of business model, it's really important that you have a business model in mind. This is one of the biggest things I see real estate investors struggle with on a day-to-day basis. They hear all these other great investment strategies. One week they hear about rent to own, the next week they hear about flipping, the week after that is BRRRR, the week after that is Airbnb, and all of a sudden they don't know where to begin. And so where you need to begin is by reverse engineering your goals. I've put together a free mini course on this entire subject matter, so if you guys go to mattmckeever.com/coaching, you can get a free 30-minute coaching session with me, essentially, where through an online course I'm going to break down for you exactly how you can reverse engineer your goals and chunk those goals into bite-sized pieces so that you can eat that elephant a bite at a time. But high level, what we need to do is we need a guiding North Star, and then we need to chunk that North Star or that big goal into milestones that we can execute on. Then we need to take those milestones and figure out which business models, what type of properties are going to best work for our personal situation, as well as the resources we have available and our market fundamentals. So for example, in video 2, I showed you guys how that duplex is easily making over $400 a month in cash flow. That works out to about $200 a unit. Now, if your goal was to make $1,000 a month in real estate income, we could reverse engineer that goal into owning 5 units that all cash flow at least $200 a month. But if you haven't created that North Star, if you haven't created that big goal and then broken it down into milestones, you're going to be constantly chasing your tail. You're going to find yourself consistently stuck in analysis paralysis because you don't have a clear indicator, a clear measure of whether a deal is good or not for your personal situation. That's it for this video series on the 1% rule. I hope you guys really enjoyed it. We're looking to create a lot more educational and teaching videos. So what I need from you guys is jump in that comment section down below and let me know what subject matter would you guys like to see me chat about next. Should we talk about BRRRRs? Should we talk about flipping, Airbnb? What other strategies, what other rules of thumb would you like to see me break down for you guys on my YouTube channel? And reminder, if you guys enjoyed this video, smash that like button, hit the subscribe button if you're new to my channel, and remember, check out Cashflow Tribe Canada. If you guys haven't already checked it out on Facebook or cashflowtribe.ca, I strongly encourage you do it right now. It's a community that myself and Ben, humble CEO, are working together to create for real estate investors that are really trying to focus on leveling up, taking action, and getting real results.